When it comes to finance, one of the most powerful ideas isn't about trying to pick the next super hot stock. Nope, it's about something much more fundamental, building something called a portfolio to protect and grow your wealth for the long haul. I mean, just think about that for a second. It's a terrifying thought, right? But for thousands of people, this wasn't some hypothetical nightmare. It was a devastating reality. And their story? It's the ultimate cautionary tale for why how you invest is just as important as what you invest in. So let's turn back the clock to the 1990s. We need to talk about a company called Enron. Now, this wasn't just some random business. Enron was one of the most admired corporations in the entire United States. It was a true Wall Street darling that, honestly, seemed like it could do no wrong. And the scale of its success was just staggering. So while the broader market, what we call the S&P 500, was doing great with a 13% return each year, Enron's stock was delivering a mind-blowing 27% every single year for a decade. It really seemed like the safest, surest bet you could possibly make. And you can bet Enron's own employees thought so. They poured their retirement savings into the company's stock. By early 2001, an incredible $1.3 billion of their 401k retirement money was in Enron stock. That was 62% of the entire plan's value, all riding on the fate of just one company. And then, the unthinkable happened. The darling of Wall Street was exposed as a complete house of cards. In just 1 year, the whole company collapsed. The stock, which had been trading at over $90 a share, became completely and totally worthless. The result was a total, catastrophic wipeout. If you'd put $1 in a diversified S&P 500 index back in 1990, your money would have grown nicely. But that same dollar in Enron? Poof, it vanished. This led to absolute financial ruin for thousands of employees who had bet their entire futures on the company. The lesson here, learned in the hardest way possible, is that simple, age-old piece of wisdom. But for the people at Enron, it was a lesson that cost them everything. And it's the core reason why we, as investors, need a much smarter approach. So, okay, if putting all your money in one place is basically a recipe for disaster, what's the alternative? Well, it's called the portfolio approach, and it's all about building a protective shell around your nest egg. See, the portfolio approach totally changes the question you ask. Instead of asking, is this a good stock? You start asking, how does this investment fit with all my other investments? It's a huge shift from trying to pick individual winners to building a strong, resilient team. Let's look at a real-world example with 5 stocks from the Hong Kong Stock Exchange. The column to focus on here is annual risk. You can just think of that as a measure of how much stock's price swings up and down. It's wobble factor. And as you can see, the numbers are all over the place, from a pretty steady 18% to a much more volatile 31%. Each one is its own little roller coaster. Okay, now watch what happens when we combine them. It's kind of magical. If you just randomly picked one of those stocks, on average, your return would be 15.1%, but with a risk level of almost 25%. But if you build a portfolio where you own an equal slice of all 5, your average return is exactly the same, but the risk drops dramatically to just under 18%. We can actually measure this benefit. It's called the diversification ratio. In this case, it means the portfolio delivered the same exact return while taking on only 71% of the risk of an average single stock. You get the same potential reward for a much smoother ride. That right there is the magic of diversification. But, and this is a big but, it's not a magic bullet. Diversification is incredibly powerful, but there are times, especially during major market meltdowns, when its benefits can seem to just fade away. The 2008 financial crisis gave us a brutal masterclass in this very thing. The reason this happens is a concept called correlation. Normally, you want different investments that zig while others zag, but in a true widespread panic, everything starts moving in the same direction, and that direction is usually down. That diversification benefit, which relies on things not moving together, gets seriously reduced. The reality of 2008 was just brutal. Look at these numbers. The US market fell over 40%. International markets, down 48%. Hong Kong, down almost 54%. And even a globally diversified portfolio couldn't escape the pain, losing a massive 48.5%. The lesson? When the whole world is selling, there are very few places to hide. In fact, During that crisis, that diversification ratio we just talked about shot all the way up to 99.4%. That means the risk reduction benefit almost completely disappeared. The portfolio became nearly as risky as any single market. It's a really sobering reminder that diversification reduces risk. It doesn't eliminate it. So, knowing all this, how do professionals actually build and manage portfolios in a disciplined way? Well, it isn't random guesswork. It's a structured three-step process designed to navigate all these complexities. First up is the planning step. This is all about understanding the investor's goals, how much time they have, and their tolerance for risk. It all gets written down in a formal document. Next is the execution step. This is where the real building happens, deciding the mix of investments and buying them. And finally, there's the feedback step, because the work is never really done. You have to constantly monitor the portfolio and adjust it to keep it on track. Now, within that whole process, there is one decision that stands head and shoulders above all the others in importance: asset allocation. Seriously, deciding what percentage of your money goes into big categories like stocks, bonds, and real estate is widely considered way more important than picking the perfect individual stock. Let's look at a couple of very different examples. First, here's the asset allocation for the Yale University endowment. They have a super long time horizon and a high tolerance for risk. So notice how little they have in traditional safe bonds, only 4%. Instead, they're heavily invested in things designed for growth, like private equity and real assets. Now, let's contrast that with an insurance company like MassMutual. Their goal isn't crazy growth. It's making sure they can reliably pay out claims. So their portfolio is basically the mirror image of Yale's. Look at that, over 80% is in stable, income-producing things like bonds and mortgages. This just goes to show how your asset mix has to be tailored directly to your specific goals. Okay, so this all sounds great for big institutions with teams of experts, right? But how does an everyday person actually do this? Well, the good news is there are some incredibly powerful and accessible tools available to every single one of us. The two most common tools are mutual funds and exchange-traded funds, or ETFs. Think of both of them as ready-made baskets of investments that give you instant diversification. The main difference is how they work. Mutual funds only get priced once at the end of the day. ETFs, on the other hand, trade all day long, just like a stock. ETFs also tend to track an index, which often means lower fees and better tax efficiency for you, the investor. And that brings us right back to where we started. After hearing the story of Enron and seeing the real power of a portfolio, it's worth taking a moment to ask yourself that question. The ideas we've covered today aren't just theory. They are the absolute foundation of smart, long-term investing and, most importantly, protecting your financial future.